I'm Daniel.
I'm Miro.
So today, the S&P 500 just completely shattered records. We are talking about a massive surge of 1.5%, closing at an all-time high of 7,365.12.
Right, which is just a massive number.
It really is. And, the main catalyst for this rally was this sudden sort of tantalizing prospect of world peace.
Which is wild because the reality on the ground is, well, it's very different. We're still seeing active missile strikes in the Middle East, plus some very explicit hawkish warnings about inflation from the Fed.
Yeah, exactly. So today we are doing a deep dive into how Wall Street essentially put on noise-canceling headphones to just tune out the chaos and focus purely on a collapsing oil price.
It's definitely a fascinating paradox to unpack. Our mission for today's deep dive into the market sources is to explore exactly how that collapsing crude oil price combined with some incredibly resilient morning macro data, powered this record rally. We're going to look at the mechanics of why the market feels confident ignoring those Fed warnings and why military skirmishes are just being brushed off as background noise.
It is a wild disconnect between the trading floor and the real world. But before we jump into the timeline in our first session, I need to explicitly remind you that this deep dive is strictly for market context and discussion.
Right, absolutely.
This is not personal investment advice or an investment recommendation. Okay, so let's unpack this.
Yeah, to understand this bizarre disconnect today, we actually have to rewind to the overnight hours. Let's open our first session and ask the question, what set the stage before the U.S. session?
Right, because today's narrative didn't just magically start at the morning bell. We have to look at the massive carryover story from yesterday, May 5th.
Right, the whole Project Freedom situation.
Exactly. The U.S. had just initiated Project Freedom. And for those tracking the geopolitical side, this was the military operation designed to aggressively escort commercial ships through the Strait of Hormuz.
To basically break the ongoing blockade.
You got it. It was highly kinetic, the tension was just palpable, and oil prices were heavily reflecting that fear. But then the narrative abruptly shifted overnight into today, May 6th.
It was an absolute whiplash moment for the energy markets. President Trump posted on Truth Social that Project Freedom was suddenly paused.
Paused, just like that.
Just like that. The reasoning provided was that there is serious, tangible progress toward a sweeping peace agreement with Iran. So, we went from active military escorts and a hardened blockade to a diplomatic pause in a matter of hours.
Wow.
Yeah, and the prospect of ending that blockade and securing safe passage immediately began deflating the massive geopolitical risk premium that had been propping up crude oil.
The pressure valve was just blasted wide open. But, it wasn't just overnight peace hopes setting the table for equities. The morning macro data played a huge structural role here, too.
Oh, absolutely.
At 8:15 a.m. Eastern Time, the U.S. ADP private payrolls printed a gain of 109,000 jobs for April. And that beat the 99,000 forecast.
Which is pretty much the textbook definition of a Goldilocks print for the current market environment.
Right. Not too hot, not too cold.
Exactly. It's resilient enough to send off those lingering recession fears, showing that companies are, in fact, still hiring and the economy is humming, but it's cool enough to avoid triggering a wage inflation spiral.
Because if that number had printed at, say, 250,000, the market would have immediately panicked.
Oh, massive panic. Everyone would assume the Fed was going to be forced to hike rates further, and conversely, if it had printed negative, you'd see widespread panic about an impending recession.
So 109,000 just sits perfectly in that sweet spot.
Yep.
But, the morning wasn't completely without its complications. Just 15 minutes after that perfect payroll number, at 8:30 a.m. Eastern Time, the U.S. Treasury drops its refunding announcement.
Right.
They announced a $125 billion refunding plan, aiming to raise $41.7 billion in new cash. And here is the detail that really caught my eye in the sources.
The TGA balance.
Exactly. They noted the Treasury General Account, the TGA cash balance, could peak at an astounding $1 trillion in late July.
$1 trillion.
Yeah, and they are relying heavily on short-dated bills to get there.
That is a staggering amount of cash for the Treasury to just hold. And we really need to unpack the mechanics of what that means for you, the listener, and the broader financial system.
Right, because it's not just sitting in a vacuum.
No, not at all. Think of the TGA as the government's massive checking account. When the Treasury issues billions and billions in short-term debt to hoard that cash, banks, money market funds, and investors use their available capital to buy those bills.
So the mechanism at play here is a direct liquidity drain.
Exactly. That is cash that is suddenly locked up in the government's checking account rather than sloshing around the stock market or being lent out to businesses.
And this is where I actually have to push back on this neat, tidy Goldilocks interpretation the equity market is running with today.
Okay, let's hear it.
I want you to consider if this setup is actually an invisible trap. The Treasury is basically vacuuming up liquidity at a historic pace to hit that $1 trillion TGA balance. So are equities prematurely celebrating the soft landing and fading inflation, while the Treasury's plumbing maneuvers are quietly and methodically tightening financial conditions in the background?
That's a really good point.
I mean, it feels like the market is throwing a massive party on the deck of a cruise ship, completely oblivious to the fact that the water is being steadily drained out of the pool beneath them.
That is a phenomenal way to visualize it. The surface-level macroeconomic data says the economy is doing just fine, but the underlying plumbing of the financial system is getting significantly tighter.
Right.
If we connect this to the bigger picture, the market is entirely focused on the immediate relief of that oil premium fading and willfully ignoring the mechanical drain of liquidity happening in the background.
Completely ignoring it.
Yeah. So to briefly summarize our morning setup, overnight peace hopes deflated the oil balloon, and the Goldilocks ADP data gave equities a bright green light, effectively masking the Treasury's liquidity drain.
It set a perfectly bullish, if slightly precarious, stage. Let's take a short break, and when we come back, we'll explore how this unstoppable upward momentum collided with some actual, real-world chaos right after the opening bell.
Sound good.
Okay, we are back. Moving into session 2, we have to ask the critical question. What moved markets during U.S. trading hours?
During the U.S. trading hours today, the dominant, unavoidable driver of the day, the thing that dictated action across almost every single sector, was the absolute collapse in the energy markets.
It was a bloodbath for oil.
It really was. WTI crude plummeted over 7% to settle at $95.08 a barrel. And Brent dropped nearly 7.8% to $101.27.
And the specific catalyst for that massive leg down happened during the U.S. afternoon, right?
Yeah, exactly. At 2:08 p.m. Eastern Time, President Trump told Fox News in an interview that he is optimistic about signing a framework agreement with Iran within a week.
Within a week. That timeline is what sent oil off a cliff.
Completely. Because it instantly removes that energy shocks as lagged consumer tax dynamic we've talked about in previous deep dives.
Right, and we don't need to relitigate that whole concept, but the mechanism is crucial here. When oil prices drop that aggressively, and that suddenly, it instantly frees up consumer wallets.
It acts as an immediate tax cut at the pump.
Exactly, which translates directly into a margin boost for the consumer discretionary sectors. People suddenly have more money to spend on Amazon, on streaming services, on eating out.
Right. But building on that, what's truly fascinating today is the absolute disconnect between that consumer market euphoria and the kinetic reality on the ground.
Oh, the geopolitical side.
Yeah, because while equities were surging on the promise of an imminent peace deal, actual lethal military skirmishes were still happening. Yes, today. At 12:58 p.m. Eastern Time, U.S. CENTCOM forces had to actively disable an Iranian-flagged tanker that was attempting to evade the blockade in the Gulf of Oman.
Wait, and the chaos didn't stop there, right?
No, it didn't. Just minutes later, around 1:14 p.m. Eastern Time, Israel conducted a targeted airstrike in the southern suburbs of Beirut, killing a senior Hezbollah commander, Malki Blout.
Okay, wait a second. If a sweeping peace deal is supposedly imminent literally within a week, why are there still active naval engagements and airstrikes happening? That feels completely contradictory to the narrative driving the market.
It does seem contradictory until you view it through the lens of geopolitical brinkmanship as game theory leverage.
Okay, unpack that.
We've touched on this framework before, but applying it to today's events explains exactly why the market isn't panicking. In game theory, geopolitical events aren't random, unpredictable natural disasters like a hurricane.
Right, they're calculated actions.
Exactly. They are designed to maximize leverage. Historically, military strikes almost always escalate right before a peace deal is signed.
Because everyone wants the upper hand.
You got it. All parties involved want to show maximum strength and secure the absolute best terms right before they freeze the map and put pen to paper.
So the market is treating these strikes as the final violent gasps of a conflict before the ink dries.
Pretty much, yeah.
But applying that same game theoretic lens, I actually have to challenge Wall Street's blind optimism here. My question to you, the listener, is this. Is the market dangerously mispricing the timeline of peace? Treating active, lethal strikes as just background noise assumes the deal is already guaranteed. In reality, brinkmanship is at its most volatile and unpredictable right before the resolution. I mean, one miscalculated strike could derail the entire timeline.
That is a very sobering perspective. And it becomes even more relevant when we look at what else the market actively chose to ignore today.
You mean the Fed?
Yes, the Fed. It wasn't just military strikes in the Middle East. Equities also completely put blinders on regarding domestic monetary policy. We had two major Fed officials speak today, and both delivered incredibly hawkish messages that normally would have sent the S&P lower.
Oh, tell me about it. At 9:35 a.m. Eastern Time, we heard from the Fed's Alberto Musalem, and he did not mince words.
What did he say?
He explicitly warned about rising input costs across the board, specifically citing sticky materials like aluminum and helium. He stated very clearly that plausible scenarios exist for prolonged, steady rates.
Wow.
Yeah, he is looking at the physical economy and saying, look, inflation is entrenched in the materials we need to build things, and we might have to hoard rates high for a very long time.
And then the plot thickens even more, because at 1 p.m. Eastern Time, Chicago Fed President Austin Goolsbee stepped up to the mic and delivered a highly nuanced, fascinating warning about artificial intelligence.
AI, what does AI have to do with the Fed?
Well, he pointed out that AI productivity might actually overheat the economy rather than cool it down.
Now, that sounds entirely counterintuitive. Usually we think of technology making things cheaper, faster, and more efficient, which is inherently deflationary. How on earth does AI cause inflation?
The mechanism behind Goolsbee's warning is the wealth effect. And we actually have historical precedent for this.
Like the dot-com boom.
Exactly like the dot-com boom.
Yeah.
If consumers and investors believe that a new technology like AI is going to massively increase their future wealth, corporate profits, and personal income, they don't wait for that wealth to materialize.
They pull it forward.
They pull that expected future wealth forward and spend it today. It's the psychological equivalent of buying a luxury car today because you are 100% confident you'll get a massive promotion next year.
I see.
That speculative spending behavior drives up current demand and current inflation, which keeps the Fed's hands tied on cutting rates.
So, to summarize the sheer stubbornness of the U.S. trading hours today, we had an equity market that put on noise-canceling headphones to completely ignore explicit hawkish warnings about the AI wealth effect and turned a blind eye to active missile strikes in the Middle East.
Basically, yes.
The only thing the algorithms and the trading desks cared about today was the collapsing price of oil and the promise of a peace deal. Let's take another quick break before we dive into the actual corporate mechanics that built the foundation of today's record rally.
Right, that brings us to session 3, asking the question, corporate events recap, and what to watch next.
All right, let's talk about the actual engine room of today's record 7,365 S&P close. Because underneath the macroeconomic noise of oil and interest rates, there is an absolute fire hose of capital expenditure happening in the tech sector.
The AI CapEx arms race.
Exactly. The AI CapEx as cycle-agnostic arms race is fully engaged. Late in the prior session, around 4:23 p.m. Eastern Time on May 5th, so occurring outside of U.S. trading hours today, a massive development dropped.
What happened?
Anthropic committed to spending $200 billion with Google over 5 years.
$200 billion, with a B. That is a staggering commitment of capital.
It really is.
And it wasn't an isolated event. Elon Musk's XAI is officially being dissolved into a new entity called SpacexAI.
Wait, really?
Yeah, and right out of the gate, they immediately signed a deal for Anthropic to access the Colossus One supercomputer to massively boost their Claude Pro and Claude Max capacities.
Now, if you're wondering why a $200 billion deal between Anthropic and Google matters to your broader portfolio, you really have to look at the supply chain.
Precisely. What is crucial to understand here is the cascading effect of this money. This isn't just about Anthropic cutting a check to Google or SpaceX.
Right.
This scale of capital expenditure guarantees ironclad revenue visibility for the entire underlying ecosystem. It secures demand for the semiconductor designers, the physical server manufacturers, the energy grid providers powering the data centers, and the massive cloud platforms.
It just ripples outward.
Exactly. It signals to the market that regardless of what the Fed does with interest rates, these mega-cap companies are going to keep buying hardware at a historic, unprecedented pace to win the AI race.
Now, shifting gears away from the AI boom, let's look at a story that is strictly relevant to the European auto sector, but has massive implications for global trade.
Okay, let's hear it.
At 8:35 a.m. Eastern Time today. So, before U.S. trading hours, U.S. Trade Representative Greer made some very pointed comments. He stated that the EU is past due on compliance with the Turnberry Agreement.
Oh, that's not good.
No, it's not. He formally refused the EU Parliament's recent amendments, which elevates the very real threat of 25% auto tariffs being applied.
To give a quick explainer on the context here, the Turnberry Agreement is essentially a framework designed to maintain trade harmony and avoid retaliatory tariffs between the U.S. and the EU. So by saying they are past due and rejecting the amendments, USTR Greer is signaling a potential breakdown of that harmony. And the European response was predictably swift. German and French ministers pushed back hard, framing the threat as a harsh negotiating tactic rather than a finalized policy.
And we want to be perfectly clear here. We are looking at this strictly through the impartial lens of supply chain disruption and market mechanics. We are not taking sides on the US-EU tariff debate.
Absolutely not.
But the mechanical reality is, if those 25% tariffs materialize, it is a massive headwind for multinational supply chains. It immediately disrupted the markets today, resulting in a 1.6% drop in European auto indices.
Yeah, pulling down major names like BMW, Mercedes, and Volkswagen. It's a stark contrast to the global cooperation we're supposedly seeing with the Iran peace deal.
It absolutely is. Finally, let's touch on one narrower consumer tech story from the prior evening to show how the market is treating micro-level risks. At 5:01 p.m. Eastern Time on May 5th, again, outside of today's trading hours, SpacexAI filed an ITC complaint and district court lawsuits against Amazon.
Against Amazon. Over what?
They are seeking to block the import of certain Amazon smart devices over alleged voice technology patent infringement.
Now, on paper, seeking an injunction to block Amazon devices at the U.S. border sound like a massive regulatory headache.
You would think so.
But the market reaction tells a fascinating story about investor psychology right now. Ceren's shares actually fell 4.8% today, while Amazon managed a modest 0.55% gain.
Why does Ceren's dropping matter here?
Because it shows that investors are completely ignoring micro-level regulatory risks or patent fights. The macro AI narrative is so blindingly strong that investors just aren't sweating the small stuff when it comes to the megacaps.
Well, speaking of not sweating the small stuff, I think it's time for our closing bell moment.
Go for it.
As we hear the closing bell ring, it seems the only thing sinking faster than crude oil prices today is the lifespan of Elon Musk's standalone XAI company. With the S&P hitting record highs. Enjoy the victory lap today, folks. Just make sure to keep the cheering down. If Chicago Fed President Austin Goolsbee hears us celebrating and feeling too wealthy, he might just hold rates steady for another decade to cool off the vibes.
Very true. We definitely have to keep those wealth effect expectations in check.
We do.
Before we wrap up, let's walk through the upcoming 24-hour calendar, because the economic data certainly doesn't stop for a market rally.
What's on deck?
On Wednesday at 10:30 a.m. Eastern Time, we get the EIA Weekly Petroleum Status Report. This is going to be incredibly crucial for reading actual crude inventories right in the middle of this volatile Strait of Hormuz news.
Then at 1 p.m. Eastern Time on Wednesday, the Fed's Austin Goolsbee speaks again. Let's see if he doubles down on that AI overheating theory and the wealth effect.
Yeah, that will be interesting.
And at 2 p.m. Eastern Time, we get the Treasury buyback results, which will give us a peek into that liquidity plumbing we discussed earlier.
Moving forward to Thursday, at 8:30 a.m. Eastern Time, we have weekly jobless claims and Q1 productivity and costs. And then Friday is the absolute main event.
The big one.
Yep. At 8:30 a.m. Eastern Time, the April Employment Situation Report drops. That broad jobs data will be the ultimate test of today's resilient Goldilocks narrative.
It certainly will. The resilience of the mega-cap tech trade continues to defy gravity, building an incredible historic rally on the back of falling oil and a massive fire hose of AI spending.
It's been a historic day.
But as we sign off, I want to leave you with a thought connecting back to our opening. We talked about how the market is treating the complex landscape of geopolitics as completely clean binary and resolved, but the reality is much murkier and highly volatile.
It really is.
Let us know in the comments if you think the market is right to aggressively price in peace today, or if we're all celebrating a bit too early while the Treasury quietly drains the pool.